Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for November 21st, 2021. I'm Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and Tim Denoyer, who is the head of all things trucking analytics at ACT Research. Good morning, gentlemen.
Good morning.
Morning, Ken.
Well, it's Turkey Week.
Yep.
It's Hate Week. It's the week we play that team up north. Down here in Ohio, we've got Tim repping JMU in the background, starting that petition to get them bowl eligible, apparently.
Oh,
It's a silly rule, right? I could see if you were going down a division, right, with all of your resources to get blocked, but to go up, you think it's like harder those first couple years.
right. 10-1. Come on.
Yeah, I told you backstage, they can easily take Michigan's place in the bowl because I don't think, last time I checked, cheaters really shouldn't be allowed to participate in the postseason. But we're going to take care of that this weekend, I think. All right, we got a lot to cover. And for those asking, yes, this is indeed my annual turkey shirt. I had to rep it over and above my Ohio State shirt this week. That shows my unrelenting dedication to seasonal holidays. Tim, do you mind giving it an intro for folks who aren't as familiar with you? I know you've been on a bunch of times with us and you're a friend of the show, but
No, absolutely. I think you gave a good overview. But ACT Research is sort of all things commercial vehicles, classes 5 through 8 vehicles is kind of where we specialize on new trucks, used trucks, freight markets, and things, topics like decarbonization. We do a lot of work with various players around the industry on all that stuff.
Great. Awesome. We're going to jump into our market update so we can bring Tim back at the end. I know it's always a great discussion, and it will be heading into what I hear is peak shipping season. Not so much this year. All right, let's go to our key points of the week. So reefer spot rates improve, but dry van and flatbeds continue to flatline. Those last two equipment categories are not good. I have some information I can actually share too. Got a little armchair analytics I was able to complete this morning with the kids out of the house. Single-family housing starts and permits up slightly in October. Flatbed demand still soft. I have to imagine a little bit of that is the slight backslide we've seen in mortgage rates. I'm sure Dean will explain that in more detail for us. Class 8 net truck orders. Here's where we're really getting into Tim's wheelhouse. Above trend levels, third best order month in a year. And then Thanksgiving travel. It is not a good day in the Midwest and Northeast to be out there traveling about. The weather is absolutely terrible. But today and tomorrow are the two busiest travel days of this time of the year. Special thanks to all those truckers who will be putting those turkeys on the table. We know that they don't typically abide by a your average holiday schedule. So we thank them for keeping things rolling. So with that, turn it over to Dean for our market update. Dean?
Yeah, thanks, Ken. Let's start off with the load to truck ratio and dry van. Volumes are down about 32% year over year, and also 32% lower than the week 46 pre-pandemic average. Up slightly last week, not surprising that they did move up. Given the busy shipping week this week. Carrier equipment posts down about 10%, load to truck ratio at 1.96, some of the lowest we've seen in many years at that level. Refrigerated load post volumes up 5%, obviously a lot of Christmas trees and food shipments moving ahead of this weekend. Load post volumes in the spot market for reefers are still 37% lower than last year. Load to truck ratio at 3.40, also the lowest in many years. Flatbed volumes dropped for the third week, down 2% week over week. Volumes are about half what they were this time last year in the spot market for flatbed carriers. Load to truck ratio sitting at about 5.18 loads per truck. Having a look at some of our markets, we'll stay in the Pacific Northwest for dry van and reefer for obvious reasons. A lot of growers are getting Christmas trees in particular into markets ahead of next Monday. That's the busy day when they have to be positioned. Outbound Pacific Northwest dry van rates up 7 cents a mile to $1.59. Interestingly, that's exactly the same as what they were in 2019 for this time of the year. Oregon reported some of the most gains, rates up 11 cents a mile to $1.55. They'll probably end at around $1.70 by the time the season's over. Portland to Stockton at about $1.32, rates up 15 cents a mile. Having a look at our top 5 states, just to wrap up the dry van section, California, rates dropped for the third week in a row to $1.95. Texas, rates at $1.39, just 4 cents a mile higher than where they were in 2019. Remember, folks, these are line haul, excluding fuel. New Jersey rates dropped 2 cents a mile to $1.39. In our top 5 states, only Illinois and Georgia were the 2 states to post gains. Rates were up 3 cents a mile in both markets to $2.05 and $1.50 respectively. That's Illinois and Georgia. In refrigerated market, obviously Pacific Northwest Christmas trees moving in reefers. It's the largest region producing Christmas trees this time of the year. Rates at $2.47 for loads to carriers on the outbound side. At that level, they're up 16 cents in the last week and up 40 cents in the last month. At $2.47, that's the 3rd highest level in 8 years for outbound reefer loads in the Pacific Northwest. Volumes up 6% last week. The number of loads moving are about 10% higher than this time last year. Fresno rates at $2.28 a mile, up 3 cents a mile. Loads moved were up 13% last week. And on the high volume lane north to Seattle out of Fresno, loads were paying carriers $2.15. That was down 6 cents a mile week over week as carriers worked to position their assets into the Pacific Northwest to take advantage of higher paying outbound loads. In flatbed, after dropping for the last couple of weeks, load post volumes were up slightly in Houston, although spot rates remained flat at $2.03. At that level, line haul rates are 36 cents a mile lower than last year in Houston and almost identical to this time in 2018. One of the busy lanes we like to watch from the flatbed market is the flatbed lane to Lubbock, Texas in the Permian Basin oil field. Rates down 2 cents a mile last week to $2.30. Volumes were down 5%. That's the volume of loads moving. Lastly, in Gary, Indiana, the nation's largest steel producing markets, rates down 2 cents a mile to $2.30 on 6% lower volume of loads moving. And lastly, wrapping up our market update with our year-over-year look at spot rates. Dry van rates moved minimally last week, remaining flat for almost 8 weeks, about 15 cents a mile lower than last year, sitting about 2 cents a mile higher than 2019, as you can see, compared to the green line in the chart there. In refrigerated, rates up 2 cents a mile last week, sitting around $1.97 excluding fuel. They've been up 7 cents a mile in the last month, sitting about 14 cents a mile lower than this time last year and about 7 cents a mile higher than 2019. And lastly, in flatbed continues to lose ground. Rates down a penny per mile last week, sitting at about 186. Rates are 18 cents a mile lower than last year. And as you can see, just 4 cents a mile higher than the green line in 2019. That's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update this evening and download the long form version of this report. Back to you, Ken.
Thank you, Dean. We're not going to spend a ton of time here. I think a blanket explanation that all of these forecasts that I'm about to describe, the seasonality is so dominant this time of year in the short term that that's pretty much all you're going to see. So we start with dry van. The blue line is the historical 7-day weighted moving average excluding fuel. We've got 4 forecast models, a short term in red, our ratecast model, which is our flagship in green, and then 2 intermediate models that look at different blends of long and short term in gray and yellow. And like I said, both the seasonality and the recent behavior are just overexerting themselves in for incredibly similar forecasts. If anything you would tease out of this is that the short term is maybe a little bit more bullish towards the second half of the forecast horizon, maybe by a few pennies. But what you're going to start to see, these charts effectively become rather, they're not useless, but they're not as useful as the rest of the year. If you don't know what happens this time of year, I think it's a good way to reinforce that this is what happens. But essentially, this chart is just going to go like this. I'm assuming that's the right direction on a camera, but it's going to go up and to the right very sharply as we head into the end of the year, which is a trend you see in spot rates next. We'll see a dip after Thanksgiving. As you can imagine, there's a lot of refrigerated goods being shipped around right now. That dies off a little bit and then comes back again with a lot of the same refrigerated things that we have around Christmas time. And then flatbeds, they don't move this much this time of year. The weather's terrible. It's cold. There's not a lot of building projects going on up north. And the real reason that this trails off up and to the right towards the end is primarily an out of service phenomenon where the truckers just aren't around, where there's still some background freight moving. So the rates per mile go up to entice folks to stay out. So that's the short term forecast. We'll bring Tim back and get a bit more of a picture into what's happening long term.
Yeah, thanks, Ken. Tim, great to have you back on the show. On the last show, you talked about a market description. I think you called the market peak looseness. So in that vein, as the Class 8 truck orders drop, what's the market vibe, according to your latest report, as we head into 2024?
It's a great question. Thank you, Dean. I think, one way to characterize it is that we're going through this long bottom. I think that was a while ago that I said that, and it really, it's true, but it's a lot of slow progress in terms of, the market can bounce along the bottom for a while. I do have some good description of the vibes from a data perspective, of course, and I'd like to share our for-hire fleet survey. We survey several dozen fleet managers every month, from typically fleets that have several hundred trucks. We've got the mega fleets involved, but it's a great group of the for-hire carriers, and to get a sense of what they're feeling. So the first slide will kind of tell you from a volume perspective, they're not feeling wonderful at the moment, but it's gone from bad to fairly neutral in the past several months, and so we're calling this sort of the late stages of a 19-month downturn in for-hire volumes that you can see really started. It's about as long as a typical for-hire downturn, historically speaking. So stabilizing is one sort of takeaway. Well, freight rates are stabilizing too. On the next slide, we're seeing rates fall more slowly overall. Anything below 50 on these diffusion indexes is contraction. Anything above 50 is growth. We are hearing some anecdotes of growth, increases in rates from fleets. I've spoken to several in the past few weeks who are saying we're getting low single-digit increases in some contract rates. So it's a little bit more positive than some of the survey data. The next slide shows what's going on with capacity, and this comes back to Ken talked about truck orders at the outset, and truck orders have increased the last couple months because we've opened the order boards for next year, but they are down significantly on a year-over-year basis, and they are suggesting that some belt tightening is happening, and our survey certainly shows pretty significant capacity tightening at these for-hire fleets. Now, as I think we talked about on the last show as well, the private fleets are growing at the same time, so this isn't the full capacity picture, but for-hire capacity is tightening. We can say that. And if we take the demand slide that I just showed and the capacity slide and sort of add them together, we can reach the supply-demand balance on my fourth slide here. And we think the market is pretty close to equilibrium. The last 3 months have actually been in a tighter market after again about 18 months of a loose market, and we've been a little surprised by that because I think that that's not what people feel out there for sure at the moment. And again, some of that's just coming from the for-hire fleets telling us that they're taking some capacity out, and demand has stabilized. So I wouldn't suggest that this means that the market's tight. Obviously, I think everyone's in a loose market, but I think this is a good leading indicator of better cyclical conditions to come, as I read there. So I think this suggests that next year dynamics will change, I think is the main takeaway. And we focus a lot on the equipment side of the equation, but of course truck drivers are a crucial piece of the puzzle too. And our driver availability index on my last slide, I think is really interesting in terms of understanding the vibe. Driver availability has been really good for the past year, but in our latest survey, we had the biggest drop in quite some time, about 2.5 years, and March 2021 was the only bigger drop, I think, aside from the pandemic. And March 2021, if you remember, was when we sent out our last big stimulus checks. So I think there's a change in vibe happening here, to come back to the vibe question, which I like. And driver pay went up a lot during the 21-22 time frame, brought a lot of people in, but I think real driver pay is declining. I made that point at DATCon. If you look at the BLS data, driver pay has started to come down a little bit in real terms, and other professions are continuing to go up. The job market's still pretty good overall, and I think that competition will eventually tighten driver supply. And I think that's really one of the key pieces of the puzzle that we need to turn the market, transition the market to a more positive direction.
So this may come as a shock to Dean and Tim, but I'm officially a tweeter as of yesterday.
I do watch sometimes, and this Freight X thing is interesting.
Yeah, so Twitter's finally come to Ohio after 10 years, so I was able to sign up. I got my ticket and got my waiting list. But one of the things just this idea of like short form analytics was interesting to me. Like, I think LinkedIn gives you 1,500 characters to play with, generally speaking. And just like, could you condense meaningful insight down into 140 characters, which apparently if you pay Elon Musk, you can get more than 140 characters and also edit your tweets, which I thought was interesting. Anyway, this isn't a Twitter comment. So I looked at the last two freight cycles, roughly defined the way you defined them, Tim, which is the year-over-year percent, the Coyote curve methodology. It was interesting. In the past, I've looked at the complete cycle before, but never just the up cycle. So just from the moment we reached absolute bottom on a year-over-year percentage basis until the time we hit the top again, what became the eventual top, right? And what's interesting is the last two cycles prior to this one, it was exactly 23 months to the month, right? So we started, the up cycle and ended 23 months. Yeah. We're 12 months in to when we hit the bottom last year. So it was last November we hit the bottom. So this October marks 12 complete months. And we are pacing over 10 percentage points behind those other two cycles where they were at this exact point in the recovery, which I think is just fascinating. I mean, so it doesn't mean we couldn't catch up. It doesn't mean that this one's going to look exactly like the last two. But if you just straight lined it out, it has a very muted recovery peaking out towards this time next year, which I think is very interesting.
I think it's important to bring Sir Isaac Newton into the discussion. The third law. We had such a huge cycle that during the pandemic that the reaction to that is going to be big. And I think we're seeing this pent-up demand still play out from a manufacturing perspective. I think a lot of the growth in private fleets that is continuing to pull freight and make for-hire conditions really soft, that's going to continue. We think elevated truck manufacturing is going to continue into next year. And that's private fleets sort of satisfying that pent-up demand from the chip shortages, which are long gone. There are still some part shortages at the OE level going on right now. We're going to transition to a point where demand softens and we stop adding capacity, and that's sort of the next phase of the cycle as we see it.
Yeah, I think next spring is going to be. I don't know that anyone's disagreeing that it's going to be a very important time in freight. I think there's a lot of nuance and disagreement around what it's going to look like, but I don't know that anyone's arguing it's not going to be critically important, because I think if we blow through spring the way that we're sort of blowing through peak right now, the fall retail peak, I think we're in some systemic trouble at that point. Like, I would consider this like secular trouble. Like, this is typical of the cycle. The cycle can be stretched, right? The peaks and valleys can be stretched, but it's still within the bounds of a typical cycle. If we blow through the spring peak with hardly a bump, I think the market's in some serious trouble.
That's fair. I mean, it's already looking like, contract rates are going to have a tough time going up next year. Yeah. On a full year basis. I mean, so that's the sort of position we enter the year in, and so I think everyone's sort of buckling in for a bit of a rough ride for a little while from the vibes I get. Again, to come back to your question, but we've got about a 5-month backlog in terms of tractors, Class 8 tractors. So when we think about sleepers and day cabs, just that part of the manufacturing sector, the backlog is a little over 5 months. And at this time of year, that's not great. And that suggests that there's going to be lower build rates, at some point next spring, which sort of changes that supply dynamic. That is one of the factors that is weighing on for-hire demand.
Tim, does that apply equally to say private fleet, day cab tractors versus sleeper cab for hire? Is there a big difference in build backlog on both those?
That's a good question. The day cab backlog has held up a little bit better than the sleeper backlog, as is typical at this time of the cycle. And yeah, I think that's it's not anything too different from the normal cyclicality.
Okay.
It does suggest that the private fleet pent-up demand isn't totally done,
Right.
which I think is your point. So yeah, that's right.
And Tim, just on your driver supply chart, we also saw the highest number, well, the third highest number of exits out of the industry in October, on the authorities side of the sector. But you're not surveying authorities. Are you including company drivers and owner operators in that data set, or is that just reflective of the employee pool within your survey cohort?
So yes, the survey data was just that small group of fleets. So it is sort of a microcosm, and it's not the entire industry.
Right.
We love to look at total U.S. Class 8 retail sales and how those compare to sort of normal replacement. If we want to understand what's happening with capacity, equipment capacity anyway, broadly, and we're still selling probably 4,000. A little over 4,000 trucks above replacement demand per month right now. That's down, so replacement demand we think is around 12 or 13,000 Class 8 tractors per month. Last month was around 16 and a half. We were up as high as 19, 20,000 per month in the first half of this year, which was a record level of new supply coming. So we've taken a step down already, which is news from again, we're sort of past that peak looseness, but the tightening is happening sort of painfully slowly.
So Tim, have the fleets jettisoned all of their aged equipment that they ran longer during the pandemic? Are they over that and we're back to normal trade cycles?
I talked to a mega fleet just yesterday who said yes to that question, and it was interesting. And like just recently, they got back to that level. Broadly speaking, probably not. There's probably still a lot of fleets out there, and when you get into vocational trucks, there's still pretty long backlogs for more specialized equipment because the bodybuilders in particular have pretty tight capacity. But that's more off-highway stuff. Broadly speaking, I think there is maybe a little bit more of that to go. Used truck prices are still under considerable pressure, and they sort of lag the rate cycle a bit. So there's probably a little bit more of that pressure to come.
Got it. All right.
Quiet day. I think maybe some people checked out early and they're out there brining their turkeys or something. I don't know.
Holiday week, we got ours in a brining.
One of the questions, sorry, Tim, one of the questions we had offline during the week was sort of if you could go under the hood a little bit and look at the new orders, right? So one of the things that happens in a cycle is people cancel orders, they change orders, OEMs extend orders because of parts availability. Is there anything going on in the background that sort of explains the data a little bit more than just a raw number of truck orders per month?
Yeah, that's a great question. It's one reason we talk about the backlog because it's sort of the cumulative level of orders relative to build, and that is another good indicator to watch. And of course, retail sales give you a sense of what's hitting the roads. But to really understand demand, it's probably better to talk a little bit about how the manufacturers open the orders, and typically they don't set pricing for the upcoming year until August, September. And so we just saw September this year. In the last 2 months, we've seen 24 order boards open. We've seen orders jump, but maybe not as much as feared, I guess, if you were if you're hoping for capacity to tighten. Of course, the manufacturers want a lot of orders, and the demand trends are pretty healthy. But if we want a tighter, market cycle, what we want is fewer orders, and they were down about tractor orders were down about 40% in September and October on a year-over-year basis. But again, that's going back, if you recall, 2022. This time, what was they were opening the order boards after environment, and things still hadn't fallen off a cliff. I guess, and profitability was still really good last year, even though the spot market had started to soften. And so, while we're saying orders are down quite a bit, they're still at sort of above replacement levels. So we're in this sort of awkward phase where demand is for new equipment is declining, but there's still some of that pent up demand out there. And I think we talked to a bunch of the fleets about capital planning for next year, just at an investment conference last week. And in general, of course, the LTL fleets are planning some significant capex, but most of the truckload and intermodal fleets are reducing capex and have hit those sort of the right average age of the fleets. There was another interesting comment from one of the mega fleets where they are actually going to increase the average age of their fleet, in part because they've made it more regional and they're driving fewer miles over the longer term. And so there's a mix of things happening out there, and I think it all does support fewer capacity additions as we go forward, and that's sort of what we need from a spot market perspective.
One of the things we talked about at DATCon, Tim, was replacement rates, and I'd never really fully understood the number of trucks that need to get built just to replace those. And I think the word was you use ones that just fall apart and go to the scrap heap. Can you sort of explain what the replacement number means, just for those that don't know, and the relationship from that level of 12 to 13,000 to 19,000 new orders this month?
Yeah, sure. I guess it fundamentally comes back to just how many miles a diesel engine can run, and they do last much longer than light vehicle engines, of course. But after about 1 million miles or so, they die, and so we have done a lot of studying of the sort of fleet capacity from our used truck database, where we get to sort of check in with the trucks later in life and see how many miles they've run and see how old they are and all. And so we can really tell that after 11 years old or so, you can tell tractors in general are moving over to farms and other non-highway applications, and typically the one way to measure demand, replacement demand, is just what was built 10 to 12 years ago. You can do even different ways. There's a lot of different ways of measuring it. There's sort of that first level of shadow demand, where a lot of fleets replace their trucks at 4 to 5 years old. So there's going to be a wave of replacement 4 to 5 years after trucks were built, and so there's a few different ways of sort of gauging replacement demand, but at the end of the day, we have the largest GDP in the world that is served by a fleet of really about 2 million heavy duty Class 8 tractors, which do an enormous amount of the work of keeping the economy moving, and those need regular replenishment.
Yeah. Okay.
All right, Dean, you want to take us home?
Yeah. Some shout outs this week. As always, we've got Sales Chatter with Dan Deegan, 11 a.m. tomorrow. Robert Rouse is on Landline Now. This week, we've got a Thanksgiving Truckers special on Sirius XM. I'll be on Radio Nemo with Jimmy Mack this Thursday at 8 a.m. Don't forget the latest edition of the Freightvine podcast with Zach Rogers from the Colorado State University. He's also the author of the Logistics Managers Index. Next week's show, we've got Ibrahim Bayan coming to us talking about the latest trends in commercial warehouse markets and what that looks like next year. So back to you, Ken, to wrap up the show.
All right, Tim, how can folks get in touch with you or Act Research for all of the good stuff that you guys do?
You can find us actresearch.net. We have a good seminar coming up in February, which I hope one or both of you guys will be at.
We have to get those details ironed out.
Yeah, a lot of good truckload CEOs are coming. We've got Joe Vitrito from PAM. We've got Highway Transport will be represented. Tom Kretzinger from American Central Transport, which is a great sort of mid-sized private fleet, privately owned fleet. So we've got a lot of those types who will be joining in providing a good aspect to the manufacturing discussion, of course.
All right. Well, thank you for that. And we hope to be there in person when Dean and I, hopefully both, will be there, hopefully in February. We'll get that all hashed out. I want to thank everyone for joining us this week. One of the things I'm super thankful for is that you all take time out of your day every Tuesday to watch us. Thankful for all the truckers, again, driving down the road to make sure that we all have what we need to feed our starving children all day on Thursday. So with that, we're going to sign off. And I guess I'd be remiss without saying go Bucks.
Happy Thanksgiving.
Thanks.